All right, so when you play a video game, if you're not really familiar with the game, you start off with the easy level, and then the more experience you get, you switch it to medium, and then the final level is hard. Today feels like the stock market has been switched from medium to hard, okay? It's getting quite hard because I'm starting to see a lot of fear, a lot of pessimism, a lot of panic. It's really becoming very palpable on FinTwit, on Twitter, within my Discord, on YouTube. I can tell from some of the YouTube comments are getting more hostile once again. And it's purely people are just getting extremely emotional, okay? It's very understandable. Of course, you're dealing with money. I mean, we've all worked hard to earn what we've earned and then to invest it. And then when you see your investment go down, even though everything about the company is going in the right direction, the stock continues to tank, emotions tend to flare up, and it makes sense. But it's critically important that during these times of high emotion, high pessimism, that you keep a level head and you remain focused, okay? So I'm going to try my level best to record as many videos, put as much content out there as I possibly can to help for your sanity and also for my sanity, and also to continue to share from the likes of Peter Lynch and many of the investing books that I read, to share the knowledge that I gain. What we're going through right now is nothing new, okay? All of the successful investors over the past century has been through moments of volatility. They've been through bear markets. And the brilliant thing is that we have the blueprint, okay? We're not playing this game blind. We have the blueprint for how we succeed and how we beat the market over the long term. And it's all found in their books, okay? So I'm going to continue to gain as much knowledge as I can and continue to share that knowledge with you guys so we can get through this together and come out on the other side much wealthier than when we started, okay? So that's going to be my promise to you guys. So with that said, let's just dive into today's video. Peter Lynch was recently asked on Barron's, what was his best investment, okay? And he said that his best investment was Taco Bell. Now, if you look at his investment history with Taco Bell, so in 1972, there was a sharp market correction, and the shares of Taco Bell, which was Peter Lynch's best investment, it went from $14 to $1. Now, you have to picture that. That's an 85% plus decline, okay? It went down 85%, and this happened even though the business had no debt, okay? Never had a single restaurant closure, and was overall a great business. Many businesses fall into this category of Taco Bell right now. If you look at HIMS, let's pull up HIMS for an example, right? HIMS on its balance sheet right now has total cash of $252 million. The company has no debt. Okay, the company has no debt with a current ratio of 5.2, meaning its total current assets far exceeds its total current liabilities. So for at least the next 12 months, there is zero possibility of this company going bankrupt, okay? They have a strong balance sheet, and we've covered HIMS on numerous videos on my channel. We've seen all of the wins. We've seen the revenue growth. I mean, over the recent quarter, they reported 79.5% revenue growth year over year. At least within the next 12 months, there is zero risk with HIMS going bankrupt, okay, according to the numbers that they've reported for us. However, if you look at HIMS stock, it's no secret. The stock is down 75% from its highs in February last year, okay? So the stock is down 75%. Despite no debt, the company is growing. You can consider HIMS to be a great company. Now, Lynch began buying at $7 a share and continued to do so as it declined to $1, okay? And that's a great example of an investor sticking by their conviction, okay? And this has to be the biggest takeaway from this video. As an investor, it's important that you stick by your conviction. As long as you've invested in companies that have strong balance sheets, that also has a huge revenue for growth ahead of it, stick by your conviction. Like I mentioned in my video yesterday, pessimists sound smart, but optimists get rich, okay? Peter Lynch got extremely rich from this investment simply because he stuck by his conviction. Yes, he could have listened to smart pessimists on the news, on the radio, on the TV, whatever, spreading their bearish arguments and, the market's going to crash and burn. But he stuck by his conviction. He focused on the company continued to do well, and it ended up being one of his best investments. And if you take a look at this, so by 1978, so 6 years of him buying this stock, of course the stock rebounded and continued higher, and it eventually became the largest position in the Magellan Fund. So that was the fund that Peter Lynch was running, and eventually it was bought out at $42 by PepsiCo. So taking a $7 a share as a starting point, that equates to a 600% return on an investment. Insane. Although of course Lynch's returns would have been much higher than that if he averaged down as the stock declined, which of course we know he did, because he kept on buying the dips because there was nothing wrong with the company. Stand by your conviction. Now check this out. Peter Lynch ruled the 1980s, and for good reason. From the late 1970s, when he took over the Fidelity Magellan Fund through his retirement in 1991, Lynch returned close to 30% annually. Unfortunately, the majority of investors in the fund received far less than Lynch's 29% annual gains. And the reason for that is because it's been said the average investor in his fund earned only just 7% per year. So Peter Lynch's fund over that period returned on average 29%. However, on average, the investor in his fund only received 7% per year, far less than the returns of the fund itself or the overall market, because they rushed in after the performance was good and redeemed the fund whenever it underperformed. Imagine that. So Peter Lynch, an investor that we all widely respect, he's considered one of the best to do it, one of the best to play this game. Average investor in his fund returned only 7%, underperforming the market and underperforming the fund that returned 29%, simply because they got scared when the fund was underperforming and they got FOMO when it was performing really good. And that led to lackluster returns for these investors, even though Peter Lynch is one of the best to ever do it. That's insane. And to wrap it up, Peter Lynch says it here: when stocks are attractive, you buy them. Sure, they can go lower. I've bought stocks at 12 that went to 2, but then they later went to 30. You just don't know when you can find the bottom. And with many of the companies that we've invested in right now, there seems to be no bottom. I mean, look at Beyond Meat, for example. This is a company that I don't have an investment in just yet. But where is the bottom for Beyond Meat? And I tweeted this earlier today. I said Beyond Meat trading back in the negative preceding recent KFC news tells you everything you need to know about the pessimism in this market. Any price is too high for these high growth smaller companies, and they continue to be priced to fail. Okay, and that's exactly what is happening with Beyond Meat, with OPENDOOR, with Square, with Affirm. You name it, they're getting destroyed. And as Peter Lynch has said, you just don't know when you can find the bottom. So I want you guys to know that I'm here with you. When you guys are bleeding, so is my portfolio. My portfolio is also back in the red. But bear markets don't last. Yes, they can go on for a long period of time, but they do not last. And the key is not trying to time the bottom. The key is having the conviction in the companies that you've invested in and standing by your investment. So I hope you find this video valuable. If you did, please make sure you smash the like button. And with that said, I'll catch you in the next one. Peace.